Hey everyone, what's up? Ken here. Welcome back to Life in the Future, Tesla, AI, and the world ahead. Today, I've got something a little different for you. We're diving into the Q3 earnings of Tesla Inc., but instead of just the numbers, I'm bringing you how the world is reacting, how international media and analysts are interpreting Tesla's latest results, and what that means for Tesla's present and future. So buckle up, grab a drink, and let's jump right in. First off, let's do a quick refresher on Tesla's Q3 results. Revenue came in at approximately $28.1 billion, up roughly 12% year over year. But while top-line growth looks solid, the bottom line tells a different story. Net income fell to around $1.37 billion, down about 30% from the same quarter last year. Operating margins slipped too, down to 5.8%, among the lowest Tesla has seen in recent years. So, in short, revenue grew, but profitability took a hit. On the surface, this might raise alarms. Why is an industry-leading EV maker facing margin pressure? The answer lies in several headwinds: rising raw material costs, increasing tariffs, and margin squeeze from price cuts. The numbers alone don't paint a rosy picture, but as you and I both know, how we interpret these numbers matters, and that's what we're here to explore. Let's start with the first media take, CNBC. They highlight that while Tesla's revenue increased, cost inflation ate into the profits. Their focus is on the structural challenges in Tesla's profit engine. Their article points to rising production and logistics costs, tariffs, and heavy investment into AI and robotics as key factors pressuring short-term profitability. But here's the interesting twist. CNBC also notes that Elon Musk remains very confident about Tesla's future, calling out FSD, full self-driving, and the Robotaxi vision as still key to his strategic blueprint. In other words, Tesla may be accepting short-term margin pain in service of long-term transform. This angle differs from the typical Japanese coverage, which tends to zero in on the immediate drop in profits. Next up is Reuters. Their tone is a bit more neutral and measured. They report that Tesla hit record revenue, but again emphasize the margin slump, down to 5.8%. They underline the trade-off Tesla is facing, keeping volume up via price cuts, but sacrificing margin in the process. Volume or profit, that balancing act is front and center. What is particularly noteworthy is Reuters' attention to Tesla's energy segment. The energy and storage business grew by about 44% year over year. While still a relatively small piece of the overall pie, Reuters flags this as a potential long-term growth driver. The implication? Tesla may be making early moves to shift from pure EV hype to a broader energy tech play. Then we have Teslarati, a more Tesla-friendly outlet, yet one that keeps its feet on the ground. Their piece argues that Tesla isn't just a car company anymore. It's evolving into an AI and robotics company. They highlight Elon's phrase, sustainable abundance, as more than marketing fluff. It signals Tesla's ambition beyond vehicles. One quote from Musk that stood out: "We now have a clear line of sight to unsupervised autonomous driving, so we are scaling production accordingly." That's classic Tesla. Less about this quarter's numbers, more about where the puck is going. In Teslarati's view, Tesla is setting up for the next paradigm shift. On the flip side, we've got Electrek, which takes a slightly more critical tone. Their headline teased, "Elon mentioned what he really ought to keep quiet about." They pick up on Musk's $1 trillion scale compensation vision and flag governance concerns. For instance, Musk said, "After building the robot army, I need to control it." And Electrek quoted commenters who called that statement a mix of ego and risk. In their view, Tesla's future vision, AI, robotics, autonomy, is bold. But they also ask, what about execution risk? What if the man behind the messaging becomes a liability? That duality, Tesla's greatest asset versus its greatest risk, is a recurring theme. Specialist outlets such as Drive Tesla Canada and Inside EVs dig deeper into production timing and product roadmap. Drive Tesla Canada reports that the so-called Cybercab, a fully autonomous vehicle without steering or pedals, is expected to begin production in the second quarter 2026, directly from Musk's recent comments. That's huge. If realized, it could reset Tesla's business model entirely. Inside EVs adds that Tesla is not just waiting for demand, it's expanding capacity ahead of when unsupervised FSD becomes mainstream. In other words, they're investing ahead of the curve, hoping the market catches up. Finally, let's talk what insiders are saying about the stock. On Yahoo Finance, analyst Dan Ives commented that Tesla's Q3 is a transition quarter and argued that the stock should be higher because what matters most is Tesla's long-term stake in AI, autonomy, and energy, not just this quarter's margin. In his words, the real game begins now. That's a powerful statement. Too often we get fixated on the headline numbers. Revenue fell short, margins compressed. But from an investor's lens, Tesla may be doing what it must, laying the foundation for the next chapter. So, let's pause and summarize where we are. In the international media landscape, there are three broad camps. One, short-term cautious, outlets like CNBC or Reuters focusing on margin erosion, cost pressures, and volume versus profit trade-off. Two, long-term bullish, outlets like Teslarati and Yahoo Finance emphasizing AI/autonomy/energy as Tesla's real frontier. 3. Skeptical watchers, outlets like Electrek raising governance risk, questioning Musk-centric headlines, and execution hurdles. Different lenses, same conclusion. Tesla is at a turning point. Now let's switch to Ken's take. How do we interpret all this? First, yes, the short-term numbers are rough, margin down, costs up. That's concrete and important. But I view this more as a run-up phase than a collapse. Tesla is shifting focus from being an EV volume machine to becoming a cornerstone of AI-driven mobility and energy infrastructure. Think Robotaxis, Optimus robots, Cybercab. These are all clues that Tesla is morphing into an AI infrastructure company disguised as a car maker. Second, the margin drop and the headlines around Musk's compensation can't be ignored. As investors, we need both vision and discipline. Tesla must restore margins, maintain production discipline, and navigate regulatory hurdles around FSD. That's the near-term test. Over the next year, these pressure points will determine if Tesla's vision becomes value or vapor. My view? I don't see this recent quarter as a bad result. I see it as Tesla stepping fully into its future. With tangible advances in AI, robotics, and autonomy visible, Tesla is no longer just about cars. It's about designing the future of mobility, energy, and intelligence. But, and this is big, talking about the future is one thing. Executing it is another. So I encourage you, the viewer, to keep three things on your radar: margin recovery and cost structure improvement, progress on full self-driving legality and production ramp of Robotaxis, governance and leadership risk around Elon Musk, and how Tesla handles that tension between visionary and vulnerability. We want to stay excited about the future, but grounded in reality. Before we wrap up, there's one more point worth remembering. When you evaluate Tesla, don't just focus on what the numbers are, but ask, what are the numbers pointing to? Because Tesla's strategy is, by design, multi-phase. We're in the transition, the shift from internal combustion engine replacement to scale EVs was phase 1. The shift from EVs to full autonomy and energy tech is phase 2. Tesla's telling us phase 3 is AI infrastructure meets human mobility, and that's a bracing vision. At the center of all this is Elon Musk himself. He is Tesla's greatest asset and arguably its greatest risk. If his vision carries through, Tesla might become the world's first AI infrastructure company of the 21st century. But if the governance, execution, or regulatory risk misplay, the flip side is just as real. That duality is what makes Tesla fascinating and combustible. Personally, I'm still very much in Tesla's corner. I believe this company is making bold bets on the future, and if the bets pay off, the upside could be extraordinary. Alright, that's it for today's deep dive on how the world is interpreting Tesla's Q3 earnings. In Japan, the media may focus on the drop in profits and margins, but the global view emphasizes direction over digits. And as investors and long-term thinkers, I believe that's where we should focus. If you found this useful, please hit the like button. It truly supports the channel. And if you're not yet subscribed, please join the tribe because every morning I bring you the latest on Tesla, AI, and the future of mobility. Thanks so much for watching. I appreciate it. Until next time, let's keep enjoying life with Tesla. Stay curious, stay invested, and I'll see you in the next one. Before we wrap up, let me take a moment to introduce myself. I drive a Tesla Model Y, and at home, I've installed a Tesla Powerwall, so I actually charge my car with solar energy. I truly believe Tesla is shaping the future, and that's why I share the latest news and insights here on this channel. I'm from Japan, but I want to connect with Tesla fans all around the world. That's why I also create an English version of my videos. Most of all, I'd love to connect with Tesla fans everywhere so we can support Tesla together. I also share updates on X, so feel free to follow me there and let's connect. And if you haven't already, please subscribe to this channel. I'd really appreciate it. Thanks for watching, and I'll see you in the next video.